Hi, everybody. This is Ellman, the Blue Collar Investor, with BCI podcast number 7, titled Treasury Bond Yields and the Stock Market. As many of you know, Treasury bond yields are considered risk-free investments because they're backed by the U.S. government. And another assumption investors make is that Treasury bond yields increasing is a negative for the stock market and vice versa. So today we're going to explore the relationship between these Treasury bond yields and the success of our stock market investments. Let's start with the definition. What is a Treasury bond yield? Well, it's the interest rate paid by the United States government for borrowing money from us when we purchase bonds. I mean, that's basically it. We're loaning money to the U.S. government at a specific interest rate. Now, bonds have a specific face value and a fixed interest rate. And from time to time, the Fed will alter the interest rates on new bonds being sold. Now, the benchmark generally is considered the 10-year Treasury. And that's the benchmark that guides other interest rates. So that's the bond that most investors follow. Now, the general theory here is that rising interest rates are negative to the stock market and falling interest rates are positive for the stock market. Why? Because rising rates will attract investors to invest in risk-free investment vehicles, right? As the interest rates decline, they become less attractive and people are willing to take on more risk by getting into the stock market. So that explains the inverse relationship between the two. But where is that inverse relationship meaningful? At what yield? And that's something we're going to explore in this podcast. Now, consumer confidence plays a role as well. Because if people are feeling really good about the market, about the economy, then there's less of a demand for bonds and bond prices will decline. Now, since the yield is inversely related to the bond price, that means that when consumer confidence is high, yields will also move higher because stocks become the preferred investment, despite the higher risk, because consumers are just feeling very confident about, the overall stock market, and two, and most importantly, the overall economy. Now, let's look at the other side of the coin. What if consumer confidence is low? Well, then there'll be more of a demand for bonds and bond prices will rise. And since the yield is inversely related, the yields will then decline as investors tend to move to safety. So keep in mind those inverse relationships and direct relationships. And we're going to move on now to deciding where is that key yield percentage where the stock market becomes impacted in either direction. Well, as an example, a lot of people feel that 3% is the threshold. In other words, once yields move over 3%, then the stock market will be hurt. But we're going to examine that. We're going to look at the charts and we're going to see if that's actually true. So let's go back to August of 2018, where the yields were beginning to move up on the 10-year Treasury, approaching 3%. A lot of stock market investors were getting nervous. But we're going to make a case now that this 3% is more of a psychological barrier than a real barrier, because 3% still is historically low for the 10-year Treasury. Now, for bears, they feel that rising rates negatively impact corporate debt serving costs. So they're nervous about rising rates. Bulls feel that, well, you know what? Strong earnings growth and a stable economy, that means that corporations can actually withstand modest rate hikes. So it's up to us to determine where do we start to feel that these rising rates will actually impact the stock market investments in our portfolio in any meaningful way. So the chart that I'm showing now, for those of you that are viewing this podcast, and I'll explain in detail to those who are just listening, shows time frames when the yields were up 3%, under 3%, various time frames. So for example, from July 8th, 2017 through April 19th, 2018, an 8-month time frame, the Treasury bond yield on the 10-year was up 1.2%. It moved up. What did the stock market do during that same time frame? It was up 11.4%. So the increase in yield certainly did not hurt the stock market. Now this chart has about a dozen time frames, all of them when the Treasury yield was up anywhere from 0.9% up to 2.6%. And in every single one of those time frames, 100% positive correlation, the S&P 500 moved up. On average, the average Treasury yield increase was 1.5%, and this average increase in the S&P 500 was 9.5%. So this means that 3% threshold is not reality. So if we were to look at a chart of the 10-year Treasury bond yields running back into the 1950s up to 2018, we would see yields over 15% that took place in the 1980s, and as low as 1% closer to 17 and 14. So during those years, the Treasury bond yields were under 2%. But there is a red line in this chart, with those of you viewing it, which shows yields of over 5% from the late 60s through the mid-90s. So there were a lot of time frames when the yields were over 5%. So a comparison chart of the 10-year Treasury yields compared to the S&P 500 shows three red arrows where the yields were in fact over 5%. And in each of these time frames, you could see that the S&P 500 did in fact decline significantly. So it appears that the threshold is really closer to 5% than it is to 3%, where our stock market investments start to become negatively impacted. So let me summarize. The 10-year Treasury bond yield is a key market benchmark that most investors will follow. Historical data shows that the stock market will not be negatively impacted by rising rates that remain historically low. In this case, we made a case for under 5%. So if the rates are approaching 5 and going higher, that may make certain decisions relating to the stock market a little more challenging and something that we need to factor in. At the time that I'm making this video, the 10-year Treasury was under 1%, not a factor at all. So, but there are going to be times when the interest yields are going to go up, and then we're going to have to factor that into our investment decisions. So that ends BCI podcast number 7. As always, I want to thank everybody for taking the time to view this video. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.